nuevas oportunidades, nuevos frentes que se abren en el mercado, también con la inteligencia artificial a la cabeza y que son también impulsados por la innovación tecnológica. Sobre ese auge de inteligencia artificial al que tanto estamos pendientes y sobre esa posibilidad de burbuja que, como ustedes saben, pues las burbujas, como ha mencionado durante la jornada de hoy en Financial Times, decían que la burbuja explota, termina explotando. Bueno, pues con este escenario tan complejo y lleno de contrastes para 2025, vamos a dar la bienvenida a Henry Smith, Vice-President and Investment Strategist at Alliance Bernstein. Good afternoon.
Hi there.
Hi, I would like to ask you, what is the current state of the global macroeconomic environment and what are the key drivers shaping the outlook for 2025?
Sure. So if we think back to earlier this year and the US tariff uncertainty that unfolded in March and April, when it looked increasingly likely that high tariffs would be applied across the entire world and that there would be severe growth and inflation implications for a global economy that, let's remember, was already slowing and seeking to normalize elevated inflation. Compared to that point in time, the good news is the global economy today is much more stable and has been more stable, or getting more stable for the last few months. With the passage of time, we've seen trade deals and de-escalation with respect to US tariffs, and the new regime appears largely set at this point, which helps to clear up a considerable amount of uncertainty. From here, a key question is how far and how much the effective tariff rates in the US can converge with the headline policy rates. Clearly, with a different set of tariffs applied to different regions and to different products, corporates, importers and consumers will all be trying to take actions to try and limit their tariff bill, which could distort the path from here. We've also seen some big developments in other areas of policy. So from a government perspective, we've seen the extension of tax cuts in the US's One Big Beautiful Bill Act. And in Germany, we've seen the change of fiscal rules that should drive greater defense and infrastructure spending. In the monetary policy space, we've seen major central banks continue to loosen policy rates. And I think most notably, the US Federal Reserve recently rejoined the cutting cycle in September. Given all of this, if we take all of this as a whole, economic growth expectations for 2025 have been revised up from their lows earlier this year across several regions, including the Euro area and the US. If we drill down into the US, I think it's quite important to note that consumption remains relatively resilient, all things considered, and AI-led business investment is a key driver of growth. However, one thing that investors have been focusing on quite closely, and we think is something that does warrant a degree of monitoring, is slower employment growth and some cooling in the labour market, which could just be the impact of policy uncertainty. But as I say, I think it's something that warrants closer monitoring. But overall, we expect modestly positive growth for 2025, and we expect to see some improvement as we head into 2026.
How have recent US policy changes and political events impacted markets and investor sentiment?
Yeah, so we've touched on tariffs a little bit already, which have really been the main policy headline for 2025 so far. If we think about tariffs just for a little bit longer, current estimates for where effective tariff rates will land are between 16 and 20%. To put that into perspective, we started the year with effective rates around 2%. So while where we are today marks an improvement from what was the worst case scenario that was laid out in Trump's Liberation Day in April, we are still looking at significant tariff increases and to levels that are, the highest that they've been in nearly 100 years. Tariffs effectively serve as a tax on consumers, and so they'll likely reduce consumption and slow economic growth while also feeding into higher inflation measures. When we dig into inflation in the US, we are starting to see tariffs exerting upward price pressure, particularly in more exposed goods sectors like home furnishings and motor vehicles. There are also the indirect effects of tariffs, and this is more global in nature, where they can cause elevated uncertainty or weakness in confidence that can ultimately slow economic growth and economic activity. But I think despite these effects, we have seen very strong equity market returns over the last 6 months, but also for this year so far, as investors have generally focused on resilient corporate earnings, but also the positive dynamic of policy uncertainty easing so far this year. The other political development that I think is quite important is the US government shutdown, which came into effect a week ago. For those unfamiliar with this, a shutdown occurs when the US Congress fails to pass sufficient funding plans to maintain government operations and services, and so non-essential services are effectively paused and workers are furloughed. And if we look back at history, there's been something like 22 shutdowns since 1976, and only 4 of these have lasted more than 1 business day. So where we are today with a week of shutdown is relatively unusual. But that said, the most recent shutdown prior to this took place during Trump's first term, and that was at a length of 32 days, which was the longest in US history. The good news is, while the pause in government spending can be disruptive, spending typically increases on reopening to catch up with demand, so little spending is permanently lost. That does mean that the historical economic and market spillover of shutdowns has been limited, and we expect this to hold true this time round. There are two main wrinkles, I think, this time round that we need to be thinking about. So one of those is consumer sentiment has already been under pressure from things like tariffs, and so an extended shutdown could pose further risk to consumer attitudes. And I think the second thing to remember is if the shutdown remains in place, this could delay important economic data such as labour market data that is being closely watched by the US Federal Reserve, but also by market participants.
As you said, a shutdown that apparently is continuing. What are the main risks and opportunities for investors today with this situation?
Yeah, so starting at the sort of macro level and starting on the risk side, global growth has clearly slowed in 2025. Global growth is expected to be around 2.2% for 2025 as a calendar year, which is less than the 2.7% we saw in 2024. While we've seen growth improvements in Europe and Japan this year, the main area of slowdown has been the US. And thus far, that slowdown appears to be moderate rather than severe. But it's worth noting that it's hard to disentangle how much of that slowing is due to policy directly, so due to tariffs directly, for example, and how much of that is due to the dent in business investments and consumer sentiment that has come alongside this. Linked to that, we've also seen US jobs growth, as I mentioned earlier, ground to a halt recently. But I think it's worth noting that other indicators such as layoffs and items like that do not yet point to distress. And we expect some of this is likely due to a desire for businesses to hold off on decision making until the policy landscape is a little bit clearer, rather than a desire to shed workers due to weak profitability or demand. The other risks that people need to bear in mind and that we're watching closely are volatility in policy making becoming the norm. We've seen some quite erratic policy making coming out of the US. And linked to that, I think, is the threat of US central bank independence. That is a huge risk to global stability. And the final point is we've seen exceptionally strong market returns so far this year. There's potential for a degree of market complacency in the face of continued risk and sort of longer term vulnerabilities. Balanced against these risks, I think it's worth also noting that on the other side of the coin, there are some quite notable opportunities. So inflation is now running much nearer to targets. Central banks are easing monetary policy with a view to support economic activity. As previously mentioned, the US Federal Reserve has recently resumed easing with their first cut of 2025, and other central banks have been continuing to cut and are now kind of approaching their terminal rate levels. I would also add that these terminal rates are significantly higher than what became the norm following the global financial crisis. And this is some good news because it actually means that central banks have plenty of room to tackle any potential future growth risks that may come down the track. Another key area of opportunity, and we'll come back onto this a little bit later, I think, is business investment. That is something that, while it has been broadly slowing, has been held up by very robust technology spending amid rapid adoption of AI technologies. When we look at the level of capital expenditure into technology, levels are high today, but I think it is worth reminding, if we take that historical perspective, they are not extreme in our view, especially when you compare them to things like the spending that was taking place in the late 1990s dot-com bubble.
How are your multi-asset portfolios currently positioned for this market environment, Henry?
Yeah, so given this improved growth backdrop and resilient corporate earnings that I've described, we have been gradually increasing our exposure to risk assets. And by risk assets, I mean assets like equities and credit. We've been doing that for the last 6 months or so, and today our portfolios are overweight those types of assets. Within equities, we're leaning towards US equities as they stand to disproportionately benefit from some of the robust technology growth that we are seeing. We're also leaning into emerging markets. This is an area where we expect positive global growth to be supportive, and we expect the building potential for additional support from Chinese policymakers to help tackle some of the weak domestic growth issues that they are having as another tailwind for emerging markets, alongside some of the broader macro points around a weaker US dollar and lower interest rates globally that should help to support performance. The final point I'll note is within fixed income. So we have been modestly increasing exposure to sovereign bonds or to government bonds, expecting that rate cuts that are coming will support bond prices, and that the combination that we now have of lower interest rates and more normal levels of inflation should help to make bonds more diversifying within a portfolio. That said, we are somewhat cautious still on bonds, given volatility around concerns around levels of government debt and the sustainability of fiscal budgets, as well as we talked about earlier, central bank independence.
Henry, what advice would you give to investors about navigating the current market environment?
Yeah, that's a great question. So, simply put, my advice would be to stay diversified and to remain flexible. The global economic outlook is improving, the policy environment is now more certain, and there are signs of economic resilience that we expect to persist for the near term. As a result, we have seen markets become less volatile, and they have delivered solid returns so far this year. So we think it makes sense for investors to continue maintaining exposure to risk assets to capture some of this continued upside, as well as some of the opportunity that is being presented by the enormous amount of investment into artificial intelligence and other forms of transformative technology. That said, it is important not to be complacent, because there are still several more medium to longer term risks that do remain. We've talked about some of these, but issues like historically elevated levels of government debt, like deglobalization, like climate change, and even things like aging populations, all point to higher levels of long-term inflation and greater market volatility. So we should also bear in mind issues like the US Federal Reserve and how independent that can remain, as well as some of the turbulent policy making that we've seen out of the current US administration. So given those risks, the wind can change quite quickly, and it is important for investors not to be caught off guard and to maintain exposure to more risk mitigating type assets and diversifying assets as part of a balanced multi-asset construct. So those are the main things I would give as an advice perspective. The final point I think I would add around dynamism is the importance of a dynamic investment process and expertise, being able to help you adjust your asset allocation and capture changes in market conditions as things like policy evolves through time. By being flexible, we believe it is possible to act quickly to capture opportunities across all asset classes. So that could be equities, bonds, non-traditional investments, and currencies.
Henry Smith, Vice President and Investment Strategist on Alliance Bernstein, thank you so much for all these tips and for all this information, for being with us today here at Negocios Televisión. Have a nice rest of the day.
No problem. Thanks for having me.
Bueno, pues nosotros continuamos con la mirada puesta a esa situación del gobierno de Estados Unidos, que por cierto continúa con su cierre echado, y eso sí, una empresa acaba, la empresa Calcis, la plataforma financiera estadounidense de mercados de predicción, acaba de confirmar que según este cierre del gobierno va a continuar cerrado y que es posible que continúe así durante 24 días más. Nosotros continuamos con la mirada puesta en el mercado ante esta situación de tensión política, que por cierto tenemos una última hora relacionada con la situación que está viviendo ahora mismo Francia, y es que el índice de aprobación de Macron cae al 14% según una encuesta publicada por el AVE durante la jornada de hoy. La encuesta que ha indicado que solo el 14% confiaba en Macron para abordar esa situación actual de crisis política en la que se enfrenta el país después de esa renuncia del primer ministro, de Sébastien Lecornu. Bueno, pues el AVE, que ha afirmado que la reciente caída en el índice de aprobación de Macron ha reflejado ya esa decadencia de la popularidad de su predecesor, de François Hollande.